Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso. We just wrapped up our interview with Lloyd Ippolito. Anthony, what's a takeaway or two you had?
What Lloyd, I would say, I think a lot of people view their CPA as a necessary evil, not as an asset or bringing value. But what Lloyd had talked about is that there's if you look at it, your biggest expense very well may likely be what you're paying in taxes. So wouldn't it make sense to spend some time to learn how to lower that big expense? And most CPAs were looking in history and are just busy with their head down, recording history. But what Lloyd can do, and through Wealthability, is kind of look at the long term, right? To make sure you're set up right and when you start, but also making sure you're taking advantage of the tax system to achieve your dreams.
Well said.
What were some of your takeaways, Cam?
Yeah. In addition to kind of his tax background, Lloyd is also a practitioner of infinite banking. And man, one of the things that he said that I really liked is he said that it's once you see infinite banking, it's like seeing something that you just can't unsee. And so I was thinking of an example of that. And the thought that I came across my mind was actually your lower back tattoo. For those of you listeners, Anthony has CPA written across his lower back. And once you've seen it, it's something you just can't unsee, which is very similar to IBC is, right? Once it's presented to you, it's there. So
you want to know what I do have?
What do you have?
My lower back?
I don't want to know.
Oh, wow. When you listen to the podcast, you will get it. But Lloyd had talked about one of the many books by Tim Willwright, and Cameron said he was going to show one here. And I actually went into your office to grab him so I would have two, but I did not see one in your office.
That's because I got three at home.
Okay, but I was hiding this behind my back.
Good. I was scared for a second. I was concerned for you guys because once you see it, you can't unsee it. Hope you guys enjoy this interview with Lloyd Ippolito. Lloyd is a CPA. He has an MBA, and he's a member of Tom Wheelwright's Wealthability Network, where they help individuals and business owners implement strategies to lower their tax liability. Hope you guys enjoy this episode.
Take care.
Welcome to the Infinite Wealth Podcast, where we teach clients how to build wealth and create passive income without the risk of Wall Street.
Lloyd, welcome back, man. We are excited to have you once again.
Thank you, Cameron. Great to be back.
Absolutely. If you guys have been listening, Anthony, we're not excited to have you here.
Well, he's not thanking me. He's just thanking Cameron.
Thank you, Anthony, for having me back, too.
Thank you.
To any of you listeners that have been listening for a while, or believe it or not, we got a lot of people that will binge listen our podcast. So if you guys have started to go through some of our previous episodes, you'll know that we had Lloyd on several times before. And so we're excited to have him back. And we've got a little bit more focused kind of content today for you. So Lloyd, we're just going to dive right into it. Is that all right?
Sure.
Perfect, man. For some of our new listeners, how about you give us a little bit about your background and tell us about yourself?
Well, for starters, I'm a CPA. But what makes me special is that when I work with a client, I'm always on the lookout for ways to have the greatest increase possible to the client's net worth, net of income taxes. Taxes are everybody's biggest expense. We want to decrease them, but we want to be smart about doing so as well. So that's why we rather look at it as far as a wealth increase on a net of tax basis. Beyond that, I'm also looking to build my own passive income, been practicing infinite banking, have my own portfolio of long-term rentals and my land flipping business.
See, this is where I think it's cool that if you're working with somebody that they're doing what you're doing, right? Because he's land flipping, he has some long-term rentals, he's practicing infinite banking, so he's going to know all of that personally, which I think is a lot of value.
Lloyd, you jumped right into the business side of it, man. But what's a hobby? What do you like? What do you like doing?
Tax returns.
So, I do like doing tax returns. In fact, actually, I would even like doing more is actually meeting with clients and having that one-on-one interaction. This practice has gotten so abundant in the past couple of months. Our new plan of action is to bring in more CPAs, more professional staff. And, of course, the policy will be a huge point of leverage in making that happen. And, it's actually time to get away from hobbies again.
So no hobbies.
Yeah, that's what I heard too.
No
Yeah.
hobbies other than
His hobby's building his business, man.
Well, I would say though, and for you, Lloyd, anybody listening, we got to have some hobbies. Like we got to have some time to relax, or we are going to get burnt out. And I'm actually reading a book I just started today called Buying Back Your Time. And it talks a lot about entrepreneurs where we're grinders. We think we're doing it all ourselves, and we end up kind of hindering ourselves, our health, and even our relationships. So, all right, I get off my pedestal.
Wow. Wow. Yeah. Anthony, could you stop scolding our guest for the day, please? That would be great. Lloyd, I'm a big fan of what you're doing. Keep grinding, man. Build that business. Lloyd, we work mainly with investors. We send, when somebody calls in and I'm working with somebody and they ask for a recommendation, you're always number one on my list because of what Anthony just mentioned. You're doing what a lot of our clients are looking to do. But what are some of the mistakes that you might see people making when they approach you and you start to look at kind of with the way that they've been handling their accounting?
I'd say the most common is going to be bookkeeping and record keeping. I group these together because they're very intertwined. And when we work with clients, we're big on filing returns as entities, so partnerships, C Corps, and S Corps. And when we look at the cash flow quadrant, Robert Kiyosaki's cash flow quadrant, we have employee, small business owner, big business owner, and investor. We want clients on the BMI side of the quadrant. And that's where we're going to get most of the tax benefits. But we tell them you have to behave like a big business owner in order to get the treatment of a big business owner. And that means having financials. And while accounting software has made this more and more available to end users, it doesn't make them bookkeepers or accountants. So I've gotten my share of financial data, client prepared that has negative cash, negative accounts receivable. My favorite recently has been a balance sheet that doesn't balance. And not to disparage my clients, but we believe that their core skill is going to be their investment niche. And that's kind of our philosophy of the strategy. The niche makes you rich. So we'd rather have clients have competent members of their team, whether it's in their business or whether it's third-party bookkeepers that are able to get it done right and have that focus be taken off of them. And part of the reason that's so crucial too is because when we do tax returns for our clients, we want that return to not be, okay, well, this is how much tax we're going to be paying. We should have known that 6 months ago, and we're just tying the ribbon on it now and finalizing what that data is. So without having some of this data in real time, it makes our job just not doable in order to be proactive with the client.
Okay, so what you're saying is one of the biggest problems you see investors have, they're not doing their accounting. Well, in part, probably because they're focused on growing the business and they're not maybe the whiz at balancing their checkbook. So what are some solutions to that, Lloyd?
Well, one solution really is going to be just evaluating, and this is even just the case for a bookkeeper. This is the case for any member of their team. It's going to be taking a step back and delegating what needs to be done. I feel that's been the biggest takeaway of me going through the coaching program in the Land Geek, is actually having improved my delegation skills, which has helped my own firm too. So, for example, we have teams of bookkeepers. So that means they do the bookkeeping for my firm and my land business. That means I have an assistant that's responsible for my own receipts and giving that information off to the bookkeeper so that she can go ahead and record how the credit card bill gets paid. So it's all systems. So just like any entrepreneur who's gotten this far has developed systems, it's just a matter of augmenting it to get past that last step in the financial hierarchy.
Okay, cool. What are some other mistakes that you see investors making?
Not being educated. And that's not necessarily just being not educated with taxes. Sometimes it is in their own investments. And either jumping into something too soon or not having the support to make it happen. In the land business, I've come across investors who didn't even want to buy the toolkit So they've made some mistakes. They try to go into it too quickly, and they'll buy wholesale deals and realize they can't flip it because they don't have that expertise behind them yet. From the accounting side, people sometimes starting in either without the entity or without the best choice of entity. So then when we begin working with them, we see there's some things that are in a way that's taking tax bond waiting to happen. And usually it involves owning of real estate in some corporate entity. A long-term investment real estate in an S Corp or a C Corp.
So you mentioned those different corps. So, right, LLC, and then I think you can elect whether you're an S Corp or a C Corp. What are there general rules of thumb between whether somebody should make in that election?
Sure. So I want to first start off by saying that we have tax and legal entities, and there is quite some overlap. Anytime we work with a client, we want them educated on both and have the background from the right professional. So when we do a wealth and tax strategy, for example, we bring in that asset protection attorney and make sure that they're well poised with their asset protection plan. For the most part, we usually will use LLCs over corporations, and the biggest reason for that is its flexibility, and the attorneys prefer the limited liability companies. From there, we have our gamut of tax selections. There's a handful of times where we run into an issue that we can't use an LLC and have to use a corporation. This typically is with real estate agents, where there's some nuance in their state's licensing law that requires a corporation. So beyond that, a couple of things we're going to want to evaluate are going to be, well, is this a side hustle or is this their main gig? And if this is their side hustle, then sometimes an S Corp isn't going to be suitable for that. And part of the reason is why an S Corp makes sense in the first place. An S Corp makes sense to reduce somebody's FICA taxes. So if somebody's already working a W-2 job and they're already maxing out their FICA taxes because they're making decent money with an employer, but they're trying to get out of the rat race, then the S Corp won't make sense to them, because when they set that reasonable salary, they're going to be double paying the FICA. And the employee gets his half of the FICA back. The employers don't have a way of wrestling out who gets it back, so they both pay in.
Yeah.
Generally, an activity that's going to be treated as a business is either going to be an S Corp or a C Corp. In that example, we may rely on a partnership, and there are times where it'll make sense. And it depends too, what's going to be the business plan. If they're going to get something that's going to be a loss, if somebody's going to start up a Turo business and they're going to have it be a partnership or a self-proprietorship even, then that loss is still going to pass through their return. The entity tax classification, I should say, is no benefit. We still want an LLC to isolate themselves from legal liability.
Now
another angle.
Go ahead, Lloyd.
Another angle with the C Corp comes down to whether or not they're going to retain money in the corporation, or whether or not having arbitrage between tax brackets makes sense. So somebody who's in a 32% bracket, 35, 37, they may have some benefit by having some of the money retained in the C Corp at 21%, where there's that 11 percentage point or more delta between the tax rates. And even if they can't take it as a dividend, they can still lend the money out to a company that's going to be their investing company, where they're going to acquire more real estate. 1202 is another tax benefit. That involves certain businesses, if their goal is to sell it, and we have a 5-year holding period on the horizon, then we'll set it up as a C Corp, so they're going to be able to take advantage of building that equity up, reinvesting the profits, but selling it at a tax-free gain somewhere down the line as well.
Oh, thanks for dropping that wisdom, Lloyd. And Cameron afterwards are kind of explained to you the nuggets that he had dropped.
Thank you.
But I think right here is an example. I think a lot of times people view their CPA as a liability or a necessary expense, right? I got to get my taxes done, so I got to pay this firm to do what I need to do. But I think what you're showing here is that your CPA can be an asset by establishing the right entity, but also focusing on the end result. So make sure you have the right entity and that you can that you're structured properly. Now, Lloyd, a lot of our listeners and clients, a lot of them are kind of new to getting passive income, and they might start with one turnkey rental property and build up to two. At what is there any tax advantages of putting those into an LLC?
And that's the part where the investor always has to indicate his own risk tolerance too. Because there's some numbers I just can't put on a spreadsheet and tell them what the benefit is of having an LLC, because they may never get sued. But for many people, they're going to sleep better at night knowing that they have that modicum of having the isolation between their personal and their business assets. We don't then have to make that a separate tax return. We usually always advise the client to at least consider having that be a partnership tax return. And the added benefit of that isn't even necessarily asset protection, although from the attorneys we work with, multi-member LLCs are a bit stronger than single-member LLCs. But the other benefit actually is audit. And statistically, the IRS audits far fewer partnership returns than they do 1040s, particularly those with Schedule Cs and Schedule Es. And for the listeners who don't know, Schedule Cs are where we're going to report self-employment type activity, whether it's a business or another type of side hustle, and a Schedule E for rental activities. So there is a bit of a red flag. People will say, for example, that the home office is a red flag. Our attitude is the Schedule C and E is more of a red flag than the home office deduction. So that's one example where we'd encourage a partnership filing just to keep their 1040 nice and clean. But same thing, you can't really
Just
put
the
price on avoiding an audit.
Gotcha.
Yeah, maybe you can explain that to me later too. That'd be great. I heard Schedule E, Schedule C. That'd be great. Lloyd, I've got a question about kind of wealthability, right? I've been following Tom Wheelwright for a while, big fan of his. And when I was introduced to you, or when we met, I was actually really surprised and happy that you're part of his network. Can you kind of tell us what wealthability is, and then also how it is how it is beneficial to investors?
Sure. So we identify with wealthability being part of our brand. And I think the best way to compare that is if you go to a McDonald's anywhere in the world, you'll expect that meal to be the same. It may not be the best meal, but you'd expect it to be consistent, and you'd expect it to be low cost. And that's kind of what McDonald's stands for. So wealthability, we think of wealthability as a system to reach your financial dream faster, permanently reducing your taxes, and giving you an education and a path to a better financial future. So that gentleman right here, Tom Wheelwright, that's his brand, Tax Free Wealth.
With the green screen, it doesn't show, but
I have one in my office. I'll hold it up during the intro.
Yeah, there we go. Yeah,
that's right.
I have two in my office.
I've got three actually.
I'm going to hold two of them.
Yeah.
One right here.
I got a couple in my backpack.
The background is nice, though. I mean, a number of people, whether they mean it in jest or in seriousness, tell me that ask me if it's real. So for me, my brand is being this Long Island, New York CPA. So I have my nice skyline view in the background.
That looks great.
So the best clients that come to us are the people who have read Tom's book. He has since put out another book, Win-Win Wealth Strategies, that focuses more on the actual underlying investments that have tax advantages behind them. Mm-hmm. In fact, he even dedicates a chapter to life insurance, mm-hmm. and talks about some of the tax benefits available to life insurance. So for listeners who are on the fence about infinite banking and want just another look at it, I by all means would look no further than that chapter of the book too. And part of the reason that these benefits exist is part of a public policy exception. And the idea is that life insurance is there to protect an asset. It's indemnification, the same way that you wouldn't expect you to pay tax on a medical benefit, medical benefit you get from your insurance. It's because it's meant to compensate you for a loss or an illness. And life insurance functions the same way, having a human life value assigned to an individual and being able to insure that for all that it's worth.
Well said. Well said, Lloyd. I tell you, we don't discuss as much as we should about the human life value, meaning having enough death benefit, to replace your expected income or what the insurance company will allow you to get. We're so focused on cash value. So Lloyd, thanks for pointing that out.
No, of course. And we want the two to align, of course. And we don't want to get too technical, but more death benefit is going to mean more cash value too, and vice versa.
Mm-hmm. Mm-hmm. So, Lloyd, how is the wealthability process different, say, than the local CPA?
So I think most of the time somebody comes in. So first off, it's going to be where we start off. Most people that are going to go into a CPA are, for the most part, looking in arrears, getting the tax return done for stuff that's already happened. And well, there are a handful of things that can be done to optimize a tax situation on the back end. We can have some freedom of choice with depreciation methods and other elections. For the most part, what's done is done. So in that sense, pretty much the client's only option is to, if they really want to save taxes, is put their money in qualified plans. And that's not really advice that most clients want to hear or most CPAs want to give.
Okay, Lloyd, wait, hold on. We got to dive in that a little deeper since you open that door. Why do you, so qualified plans, Cameron, are going to be like your IRAs and 401ks.
Thank you.
Why do you, that's what most financial planners do and recommend. That's also what most CPAs do. Why do you have a different perspective on that?
Well, for the most part, all most CPAs can do at that point in time. And don't get me, Anthony, Cameron, you may not be happy about this, but there are times where it does make sense for our clients.
Oh no, I would agree. Yeah, sometimes.
And part of the reason, again, is going to be evaluating not, that CPA is any worse off than anybody else, but it's also just going to be a perspective of, well, when are they having this conversation? And if you're having that conversation many months earlier, then we can be a bit more methodical in how we can address that. Now, a lot of times, especially clients that are real estate focused, and their goal is going to be, okay, well, how much property do I have to buy this year in order to meet my target? And that's not necessarily paying zero taxes. For some clients, it is. But for many, we want to be able to at least maximize those lower two tax brackets of 10 to 12%, and being able to use them up, because we're at a point in time where we have historically low tax rates. We may not see this again. They may expire a couple of years from now, so we want to take advantage of them while we can.
Now, as you had mentioned, Lloyd, most CPAs are working in arrears. And so maybe explain how your process is different.
So oftentimes when a new client comes to us, we're going to be doing a wealth of tax strategy with them. And when we do that, we're going to sit down and essentially take an inventory of their finances. And most importantly, we ask them about their dream and what long-term it means to them in order to enjoy financial freedom. And in essence, putting the price tag on that. And from there, we, to a good extent, we reverse engineer it. We're going to compare and this is why having financial education is so handy. So with clients who have read, whether it's Tax Free Wealth or even any of Robert Kiyosaki's books where he talks about financial statements, where they become very financial statement oriented. And we'll start with their current balance sheet. We'll end with what their future balance sheet needs to look like to meet that dream. View the income that would come in between now and then, and project it all out. And then from there, we can add those tax benefits in that are right for them. And that's just going to be getting to know the client. We ask a lot of questions, whether it's going to be a full wealth of tax strategy or even anytime I'm interviewing a new client. And I'm going to ask them, are you married? Do you have kids? As in, what's your current overall financial situation like? What are the types of expenses you're incurring? Are your kids at an age where we can have them be candidates for working your business and shift some of the liability from you to them, where they may not, forget about 10 and 12, they might have a 0% bracket that's not even being used fully either. Then we talk about other entities they have, and if there's any ability to have interplay among those entities. So, Cameron, to your earlier question as far as C Corp or S Corp, sometimes the answer is yes, and we'll use both and have something where we have that C Corp be a management type entity that's set to feed off that S Corp business or their real estate holdings or taxi partnerships or both, and have it provide some service to both of them. Then we also will look at
Lloyd, one thing I wanted to point out that was interesting of what you said, what I've seen with most CPAs, the questions they're going to ask you are typically more historical. What did you do, or what has accomplished? And you're having a different approach. What do you want to accomplish? Because really, it's important if we need to know what the end in mind is, or what those goals. I tell you, we call them goals, but I like how you're talking dreams. That sounds more uplifting, right? But we have these dreams, but to have them isn't really going to help us get it there. We need to have a plan. Is kind of focus on that and build up and make sure what we're doing, whether with our time and our money, is going to be focused on helping us achieve those dreams.
Well said. So, and I think, it comes back to with having those dollars that are eventually going to produce that dream. It's giving them a proper job in a proper place. So for some clients, they will come to us sometimes having an understanding of IBC. They're interested in it. Mm-hmm. And I try to enhance their education at that point too. And sometimes it's right for them, sometimes it isn't. It's, in many cases, it's all about all the human elements in becoming your own banker. And I think that's mandatory reading for anybody who has even the slightest inclination to want to do infinite banking. And I think it's tempting for them to just toss aside those first 40 pages or so, where Nelson talks about human psychology and mindset. And I think not only is that a huge mistake for the infinite banking concept, I think that's a huge mistake when you talk about any barrier that comes to success in your business and being able to overcome that from the get-go.
Lloyd, was that one of the first books that you were introduced to when you came across IBC?
It was, yes.
So, after reading that, did you have any hesitations, any reservations? What was your takeaway there?
Well, my hesitation, number one, was it sounds too good to be true, and why aren't more people talking about this? Frankly, that's sometimes the same thing that clients come to us with when they first hear, why didn't I know I could reduce my savings by this much? So I think having seen it through the infinite banking lens, I think this is the case too when people do a tax strategy with us too. I think it's seeing something you can't unsee. And I think once you have that attitude about it, you start looking at things differently. And I think it goes back to even who you associate with. I think you start associating with like-minded people.
Lloyd, because I know before you came, before you found us, I believe you had already read the book, correct? Now I'm always curious, how did you get to the book? Like what transpired to bring you to read that book? What were you looking for? What problem were you trying to solve?
See, the funny story about how I came across infinite banking was actually an accident. And I was always interested in reading on financial topics and becoming financially literate, including reading Rich Dad Poor Dad. I read, even read Tom's book originally long before I was a CPA. And, just had as part of reading I had discovered before the network. It wasn't really networking that existed. So other than books, a good amount of material that rings true financially is online. And of course, while sometimes the content of it's debatable, content is there and it's mind-opening. I came across one article actually berating the idea of using whole life as an investment vehicle. Because the article was on benefits of my-term investment difference. And the article kind of got into sometimes people over promote this and using examples called infinite banking. And I'm thinking, infinite banking, what is this? What does banking have to do with life insurance? So I kind of gone through quite a number of rabbit holes from there, and ultimately coming across the book which I read, as well as a number of YouTube videos and articles on the subject, and to me it just made sense.
Interesting. So, you mind just sharing a little bit of how you're using your policies?
Well, so for starters, I use the policies early on. I used to pay down student loan debt,
Mm-hmm.
and that was the first few policy loans I took out. Once those were gone, I went ahead and used it to buy the rental properties. While that was happening, I came across this little thing called the Land Geek, and financed the cost of first it was flight school, then it was the coaching program, and then now it's going to be getting more and more money into land deals, so I could get that stream of note income coming in. Now it's also even in the firm, so it's going to be staff expansion. So we've used it, for example, on recruiter fees, and to actually get people in the door. Also, when you're hiring people, they're not always going to be up to speed the first few weeks. They're going to be learning our software, they're going to be learning our procedures, and they're going to get themselves ready to take on clients themselves.
Mm-hmm. Yeah, I relate when
I'm sure Cameron was.
Yeah,
I'm sure Cameron was dead weight for the first few weeks.
More than weeks, more like months, but
I think we're going on years. We're going on years now, Lloyd. I'm just hanging on. Awesome, Lloyd. What would you say to somebody that was on the fence about IBC?
What happened to your
The
voice?
nice thing about IBC is that you're building a system of policies. So you could start small and put in $250 to $500 a month, and compound that with a lump sum. And I think to me that was the most ingenious part about the way I started up, because I think that instant cash value gave you the early access to cash and allowed me to start doing things with it. So I think for anybody else who's listening to this, especially if they're, say, like me, they're on the younger end and they're discovering this for the first time, they may be in a similar situation. And, maybe with the pandemic, they've saved some money by not having to make student loan payments. And, who knows what's going to happen with Biden's student loan forgiveness program, but odds are people are going to have to start, paying back that money again. So if somebody's set to do that, they may find themselves being able to take over, one of their loan payments and put that cash flow back in the policy. And then maybe they repeat it. There could be also the opportunity, let's use it to buy an asset and let that asset be something that's not only going to produce cash flow for them, but it's also going to reduce their taxes. In fact, if I may, I have an example I'd like to share.
Oh, please do. Lloyd is going to share his screen, but if you want to watch the YouTube, you can see it. But Lloyd, if you can, since most people may be listening, if you could kind of explain a little bit.
So this thing, for example, is taken from the actual policy that was issued to me when I first started independent banking. So I put down $6,000 of cash alongside $1,000 a month premium. It was roughly 2/3 to PUA, 1/3 to base premium. So in the first year, I had about $13,297 available in cash value. Now, over the next 10 years, I'll put in about $126,000 of premium and have $145,000 of net cash value on the non-guaranteed side of the illustration. So in this example here, if somebody wants to take $6,000 and use it to pay off a student loan. I chose $6,000 in this example because this is what the cash was that was put in. So this is what was available. And we can go ahead and amortize that debt around 7% interest, 120 months of that initial $6,000. And that'll lead us to paying in $836 a year to pay back this loan at the current interest rates of the life insurance company or a LELOC might charge to borrow that money. So then we'll have an interest component, and then we'll have an ending balance. But what's most important is that we have additional borrowing capacity. We not only have the fact that the loan's been paid down, but we still have part of the initial policy too that we want to think about together as available. So now next year, maybe instead of paying down debt, let's create passive income. And why don't we put half this down and buy $30,000 vehicle and put it on Turo? So now what we have is we have another loan that we're going to use to pay down this Turo note. So $15,000 we borrowed, $3,564 is our annual payment to pay that down. But at the same time, we didn't pay $15,000 for that car. We paid $30,000 for that car. We just had the dealership, and we had a credit union or a bank finance the rest of it, just because we didn't have enough cash value. That's going to be everybody's weakness at some point in the system. It's going to be lack of access to capital. And the way you improve that is by expanding your system. But we have $30,000 that we put towards that car. In 2023, we still have 80% bonus depreciation. And then a hypothetical 22% marginal bracket. This person will have $5,280 of tax savings from that vehicle. Why not take that tax savings and throw it towards the loan? Even better would be using it to start a new policy. Let's say they do that. They're going to pay down that, between that car loan and the student loans, they're going to pay that off well before the 10 years I originally set that student loan to pay off by. So that means I have a negative $3,000 end of the year. Now, I can't have a negative $3,000. I really have to either borrow that money back out and do something else productive with it, or move it over to the premium side of this table here. In either case, I have about $78,000 available. So whether or not now I want to buy maybe 2 more cars for Montero, or maybe I could buy 2 houses with a mortgage and use that to start getting rental income in. And we can have similar tax benefits available as well through accelerated depreciation. It takes a little bit more input though. We have to actually have an engineering study done, called the cost segregation study, and use that to take apart some of the depreciation we're buying on a house. But it's still quite possible to have some decent tax savings on that.
Lloyd, thank you for sharing that. And let's just be clear that I didn't know you were doing this. This wasn't planned. I was kind of giggling a little bit. Maybe I was giggling.
I was giggling a lot.
When you were explaining it, because you sounded like us. So honestly, I think whoever fed into you and explained IBC to you did an amazing job. Is that what you were going to say?
No, I was not. I was laughing at 2 CPAs giggling at each other. That's what I was laughing at. You guys pull up a spreadsheet, boldly just start giggling. Glad you guys are having a good time.
Most people, and I just want to also add that I think infinite banking is also a very underutilized tax component too. And if for no other reason, that example, you don't get a deduction for using your own money. And we may label it opportunity cost, but the tax code doesn't recognize it as an interest cost. This is an interest cost. And we can have that interest cost coupled with tax-free return on the premium side and essentially have that double tax benefit.
Well said, Lloyd. Lloyd is, I know I've sent, dozens of people, right? I brought your name up many, many times during conversations, but if somebody's looking to get a hold of you, where can they find you?
So I have a calendar link, so we can go ahead and schedule a 30-minute meeting. It's going to be calendly.com/MTS-L-Ippolito/30MIN.
We will put that in the show notes. Yeah. We'll put that in the show notes.
Now, unfortunately, with the demand we get, we do charge for clients to do an initial consult with us. It's $250 for that half hour. But what we do is we go ahead and we save that. We apply it towards future amounts if we continue working together. And there's times where we're going to get something useful even out of that first 30 minutes. A gentleman I spoke to earlier in the week, we were discussing even just simply reducing the salary that he's drawing from some of his businesses. And we saved him $9,000 just on that first call alone.
No, I mean, Lloyd, like, I think a lot of people may not understand, like, with the CPA, what they sell or their inventory is their time. And we only have so much time. And so that's why, I mean, if you want some CPA's experience and knowledge, you are gonna have to pay for your time. And there's probably other CPAs that don't charge, but they're not giving you the experience that they need. Most of them are just there to complete your tax return, right? And then there's a fee for that. But to get that advice, I mean, it just as Lloyd had said, if you were to really look at it, taxes are one, or maybe not the largest single expense that you have. So it would make sense to get some advice to lower your biggest expense.
I want to touch one more thing about what you said as far as this inventory of CPA's time, and I think this is something else that's unique to our firm. I hate hourly billing.
Me too. Yeah.
I don't even like tracking my own. I don't even like tracking my own time. And when we bill somebody by the hour, it's our last resort. We like having an offering to people our subscription. And when we have clients on a subscription, we charge them a flat monthly fee. It's predictable to them. It includes the tax prep. It includes our meetings. It includes our quick questions via email, which, I'll be honest, most of the time they're never quick questions. So we usually have to hop on a quick call anyway to kind of talk it out. But when we do that, when we have that in place, we don't bill by the hour.
Okay. Cool.
Good to know.
And some of the attorneys we even work with have that same mindset as well. And I'm sure you can appreciate that's even rarer from an attorney.
Yeah.
Well, yeah, couldn't agree more. Lloyd, thanks again, man. Really appreciate you coming on, enjoy it, or sharing a little bit about your background, and then just sharing some of your journey with IBC. Really appreciate it.
Of course. Thank you both for having me.
Thank you, Lloyd. Go make it a fantastic day.
Take care.
Thanks for listening, and be sure to subscribe so you don't miss out on the next episode. Also, check out our website, infinitewealthconsultants.com, to find our podcast along with other additional resources.